Apologies, I was muted. Hi, everyone, and welcome to today's self-directed Saturday class. Today, we have with us Abby Golar, who will be talking about accelerating wealth investing in businesses, talking about value creation, and coming from someone in the industry who has such a diverse background in the alternative investment sector. This is going to be some really valuable information, and we thank you all for being here with us today. Before we dive into the actual presentation itself, just a very quick disclaimer that these presentations are for educational purposes only. Quest is coming to you today to present to you education that you can take with you throughout your journey in the financial freedom world. So with that said, if you are looking to seek any type of tax, legal, investment, or structuring advice, it's important that you go through the proper financial channels to do so. We're going to do a very quick introduction as to what self-directed IRAs are, and then I will pass the mic to Abby to take it from here until the end when we can wrap up with a question and answer. So for now, what can I invest into? What the self-directed IRA? What is it? Why are we here with you today talking about these alternative investments that you can take advantage of? Ultimately, this is a underutilized program that out there, whenever you are investing the 401k, the most common way to do it is typically within the stock market. A self-directed IRA, specifically with someone like Quest, will allow you to park it into alternative or private investments. So kind of steering away from some of those typical investments like stocks, bonds, and mutual funds, and allowing you to park it into something that you may know a little bit better. Maybe you will want to diversify in the future and build your long-term wealth in these different ways. That would be things like real estate, private lending, and what we call private entities, which takes a lot of different forms. Mostly we see it in apartment syndications. Sometimes we see it in self-storage. We also see joint ventures, private stock, any type of LLC formation in order to raise capital. These are all the different ways that we've seen our clients utilize their IRAs, their 401ks, health savings accounts, and education savings accounts to their fullest advantage. So we encourage you as you move through this presentation today, take notes, understand truly what it is that is backing the alternative investment industry and why it might be a good place to park your money, whether that is going to be from your 401k or your personal money. We are here to educate and share with you the many possibilities out there. So with that being said, I'm going to go ahead and pull myself down. And Avi, we want to thank you so much for being with us here this afternoon.
Hey, thanks so much. I know it's a Saturday and I know people have things to do, but you know what? It's the champions that really stick around for some really good information. So I'm excited to be here. And Brianna, thanks so much. I couldn't agree more with your disclaimer. Just a quick disclaimer of my own. I'm not a financial advisor. I'm a private equity nut. And an investor that takes a look at opportunities. And I take a look at opportunities that make sense for me and the family of companies that we own. And we go buy, own, and operate them. So ask me anything you got from an operational perspective, due diligence, raising capital. Here's a resource. Not here to solicit anything. I just love the Quest Trust family and here to provide some information on your journey as you're going along and you're thinking, well, geez, maybe multifamily right now may not be the best idea. Maybe single family or maybe businesses. We're hearing a lot of your influencers talking about, geez, you should go buy these small kind of mom and pop shops. And frankly, it's not a bad idea if you know what you're doing. And just like in real estate or just like in private lending, you want to make sure that you're covered. So if there is a challenge, you can make sure that you'll be able to navigate through it properly. So when I take a look at investing in a business, or in my world, buying a business to operate for the long term, I look at a couple of things, okay, and I call the Holy Grail of value creation. One of my mentors, Gene, taught me this philosophy, and I've applied it to my daily life when acquiring companies, and it's something that I'd like to share with you. Before we get there, I want to talk about the Holy Grail of wealth creation, because wealth building is just as important as identifying value in companies. And when we take a look at building wealth, one of the things that I look at is this. I look at building wealth and preserving it. Okay, so we've got two different options here. You build wealth and you preserve it. And as the managing partner of Meridian 84, one of my goals is to make sure that we're focused on building, essentially accelerating my wealth, and then preserving it. And what market trends am I paying attention to take advantage of either scenario? I think we live in a world where one would say, well, I want to do one or the other. Well, here's the challenge that I have with that. If you do one or the other, let's say you only invest in real estate, I think that's a pretty slow way to build wealth. Like it's great, it's very stable, it's long term, it's excellent. You want to be a private money lender, awesome. But you're kind of hanging out for like a decade and a half, and God forbid we've got market changes, right? Like we live in a world today where how is it that in 2023, the average home, talking to the single family side, the average home was the average home sale was $386,700, and that increased 4.3% from the year before, even though interest rates increased. Well, that's kind of interesting, right? Like the Fed wanted to increase interest rates to slow down the economy, which they did, but they didn't factor in the inventory shortage that we had in the single family space. So for me, does buying property right now make sense? Maybe, right? If I'm looking at a tertiary market like an Indy, my team and I purchased a good number of homes in 2022 in Indianapolis to add to the portfolio. But what else did we do? The reason that we had the capital to go buy homes and to go invest in multifamily was because of this acceleration and preservation model, where we buy businesses first and then we invest in real estate. It's not one or the other. If you're a startup person and you're thinking, well, geez, all I want to do is just buy businesses. Well, okay, you're not diversifying properly, in my mind. You should be acquiring real estate, or you should be lending out your money to flippers and single-family rental funds. Like these types of things, these types of opportunities, I think are golden. So when I look at the wealth creation model, not the value creation that's coming up in a sec, but the wealth creation model, we look at it. How do we buy or invest in businesses that will cash flow and then take this cash flow and then push it over into another asset class for diversification, which is real estate? So it turns into this infinity symbol, if you will, right? We've got acceleration on one side, preservation on the other. Acceleration on one side, preservation on the other. For every business that you buy, you go buy 3 rental properties. For every business that you buy, you become a LP in a $100,000 ticket size in some fund operator somewhere that actually knows what they're doing, right? So that's the cycle, one, then the other. And with any market condition, you'll start to see what makes sense versus not. Right now, I'm seeing a lot of my multifamily friends struggle. Sucks. Many of them are going to be out of the market pretty soon. Yeah, does that mean it's a good time to buy? Potentially, but where's that cash going to come from? Right? So if you have a business that's spitting off a couple $100,000 a year, or you're partnered with somebody that owns a business, that could be really beneficial for your self-directed accounts. And then you take that capital and push it into real estate as a long-term buy and hold. So that's just been my strategy. Sometimes it works, sometimes it doesn't. I'm not, I've done a lot of this for a long time, and sometimes, I've got a snow globe instead of a crystal ball. And I'd like to think I've got maybe more of a collection of snow globes than crystal balls, which is why I hang out at the Quest events and the other events around the country, so I get to learn from people like y'all. So that's when I take a look at building wealth. I'm looking at either acquiring a business or expanding my current business. If you have one, maybe you're a real estate agent, maybe you've done well in technology, or maybe you've got some business somewhere, right? Expand it and then invest in new businesses and open up new lines of revenue. And while you do that, we start to take a look at the power of investing in real estate. Now the key is, let's say you have an exit event in either case, either a business or real estate. What do we do next? Well, the natural thing to do is to then go buy the opposing asset class. So if you have an exit event in real estate, based on your accounts and your tax advantaged strategy, then go invest in a business. Okay, now we're not going to talk about that strategy today. That could be really complicated, but generally speaking, that's the way that I would play the game. So if you're looking at acquiring a business and you're thinking, okay, 2024 is off to a pretty interesting start. Interest rates, the Fed's kind of signaling, kind of not signaling that they're going to do something with interest rates maybe later in the year. It's an election year. I'm not going to get political here. I could. That'd be a lot of fun, but I don't have an opposing point of view. So I'm not going to do that and have fun by myself in front of a camera on Saturday at 12 p.m. Central. However, when I'm looking at the future and I'm thinking diversification, I might be thinking about investing in a business. So I want to give you my thesis on how to increase value in a business. And there are three different things that you want to pay attention to after knowing that operating profit, okay, cash flow is the name of the game. That's it. If anybody tries to sell you on revenue increase year over year or the multiple increase year over year, they're just full of it. Okay, what you want to pay attention to is the bottom line net cash flow. If your cash flow is increasing, then overall you'll see stability in valuation. That's what I mean by that. If you are looking at exiting a business in 5 or 6 or 7 years, or maybe you have a business of your own and you're thinking, I'm 55, I'm 45, I don't want to be doing this forever. I want to position myself to exit. One of the things I would pay attention to is your cash flow. That's a big deal. The stability of your cash flow, if it remains, say, $1 million a year or $200,000 a year, and it maintains that level and increases over time, and you can show the stability of cash flow over time, the multiple at which you can exit your business tends to increase. Okay, this is industry dependent, of course, but it will tend to increase over time. Right off the bat, take a snapshot of this, use it, great, not a problem. But there are three value levers that you should pay attention to when you're looking at improving cash flow. This is also important if you are a private lender and you're thinking, well, geez, yeah, this sounds like a great idea. I need to go find some folks to go invest in and they can run businesses for me while I'm sleeping. Great. These are the three buckets I would pay attention to: growing revenue, operating margin, and asset productivity. Asset productivity is a little more complicated. I'll get to that here in a few minutes. But these are the three things that contribute to your cash flow. If you've got a lot of revenue and you might be considering a technology company or some kind of angel investment, and you're seeing, man, these folks are really absolutely crushing their world, and they're increasing revenue $1 million a year, or they're growing at 200% year over year. But guess what? So are the expenses, and your expenses are also growing at 150, 200% year over year. You might want to watch out on that cash flow number. It's likely that the cash flow number is staying the same or maybe even decreasing because of the growth rate that they can't keep up with, which is a problem for a lot of startups. The challenges that Small Business America has in today's world, we've all heard the statistic, right? Whether it's the Frasers, the Sanchez's, the Dybels of the world, everybody is saying, well, 10,000 baby boomers are retiring every day, and 10% of businesses, and there are like 500 business brokers in America that are worth their salt. You should go buy these businesses. Okay. In theory, this makes sense. In practicality, when you look at these small businesses, more often than not, what you're finding is you're going to have to step into the CEO seat unless you have resources that can step into that seat. Whether it be a laundromat or an electrical company or a roofing company or a landscaping company or a manufacturing company, it doesn't matter. Right? A lot of these business owners today have structured their businesses in such a way where they are the focal point decision makers in the business. That, to me, is a very big red flag. That means if my objective as an operator of a business is to step in and grow and scale the business over the next 5 to 10 years, I'm going to have to do the work. And let's face it, I'm too pretty and too good looking to do any hard labor. I mean, look at me. I'm 150 pounds. Okay, I'm lying. I'm 135 pounds wet. I know what a sledgehammer looks like. I'm damn sure not going to pick one up. This is not my thing. I go to the gym, and I'll be at the gym for like all of 15 minutes. I'll go pick up a 5-pound dumbbell and do some bicep curls. Listen, I get the satisfaction of going to the gym. I did some resistance training. I'm going to get the heck out of Dodge because lifting weights is not my thing. I just don't understand how to do that. It's too hard labor for me. Overall, though, all kidding aside, I'm gonna have to step into the CEO seat and make some decisions about how to grow the business. Unless I take that focal point off of me and give it to somebody else. The problem that Small Business America has today, the problem that baby boomers have today, is they're the center of attention. They have no succession plan. They have no technology. They generally don't have a number two that's in their business running it with them, and they're struggling to fix these problems. Oh, and they have kids that don't want to take over the business because the kids want to be Instagram influencers. Yay. So that being said, that presents a really unique opportunity. And if you have some cash that's sitting, you got some dry powder, and you're kind of wondering, well, I want a better return than a 6 to 12 to 13% year over year on my money, yeah, go take a look at investing in a business. I think that makes sense. It's a good place to diversify some cash right now, especially a business that's been around for the last 20, 30, 40 years. They saw the 90s, right? They would have seen the Y2K bug, the tech bubble, the Great Recession, and the COVID, and you got multiple market cycles that these business owners have seen and still made it through. I'm a big believer in those types of businesses. So revenue growth, if I'm looking at a business, all right, let's start here. If I'm looking at a business, I'm looking at two things. Number one, how do I grow their current revenue streams? And then number two, how are we creating new revenue streams inside of the business? Does that business have some type of add-on, some type of alpha drive? Like, what can we do to drive alpha in that business? That comes from revenue growth. Number two, operating margin. I want to be very careful on where I'm spending my money. Is my operating margin too high or too low? Industry standards are there are different standards for different industries. So the standard for, say, manufacturing, the operating margin percentage standard is different for manufacturing than, say, SaaS or a salmon farm somewhere. So I would pay very close attention to how close is this business operating margin to the standard industry operating margin. What percent? Okay, is it 10%? Is it 12%? And how far off that number am I? From an operating margin perspective, there are two things I'm looking at. Selling general and administrative costs, SG&A is what they're called. And then last but not least, COGS, the cost of goods sold. What does it take doing of the business to provide and to create the product or service and fulfill that product and service? So again, we want to widen that gap. Right? The more revenue we have, we want to make sure that my operating margin is level, and my operating margin doesn't get too out of hand. Is what happens to cash flow. It starts to compress, and that's what we don't want to see if we're investing in a business. Okay, so that's something to really pay attention to. Generally at Meridian, we're acquiring 5 to 7 businesses a year, and we acquire in 3 different industry verticals. MEP, that's mechanical, electrical, plumbing. Second is tax and accounting, and third is dental. And we've picked these industries because they're solid. They have long-term sustainability. The government is in the industry of getting paid regardless of what market condition we're in. So I love tax and accounting from that perspective. And when's the last time you ever thought about a robot hovering over your mouth performing oral surgery as a dentist? Not going to happen in my lifetime anyway. So paying attention to operating margin, I think, is really important. And then last but not least, asset productivity. All right, I'll give you some guidance on some questions that you should ask about each of these buckets in a sec, but let's review asset productivity. 2 big components here. First, asset utilization. If I'm operating some kind of heavy machinery, what percentage of the time is that machinery being run and utilized? Is it 100% of the time? Is it 20% of the time? And each of those thresholds, whether it's 0% or 100% of the time, has its own pros and cons. If it's being run 100% of the time, that means this heavy machinery is being utilized and it's making money for us. But at the same time, it means that there's a higher maintenance cost associated with it, right? So what's that balance? On the flip side, accounts payable and accounts receivable. When I look at accounts payable and accounts receivable, I do not want to get into the mess of my receivables not being, my receivables kind of outshining my payables. My payables outshining my receivables. Essentially, I don't want to have more month at the end of the money. If my accounts payable is, let's call it 90 days, and my accounts receivable is 120 days, I have a cash flow problem. Then I have to go to the bank and get some kind of loan to cover my expenses, until which time I get my money. So these are all really big drivers of operating profit and cash flow. Okay, big deal here. Let's get into revenue growth for just a quick sec, and then I'll open it up for some questions. If you've got questions, feel free to shoot them in the chat, and I'll move off of my presentation screen, and I'm happy to answer some questions. Or Brianna, if you could just read off some questions, that'd be great too. But there are two things here. When I'm focusing on my current revenue streams and not creating my new ones. All right, so we're going to get to the new revenue streams in a second. Really, I want to pay attention to who are the top 20% of my customers and clients. If I've got the top 20%, what can I do to sink my teeth into them more? And that can inform number 2, which is new revenue streams. that's a really unique opportunity. For many of us, that could mean just turning on a light bulb and all of a sudden we have a revenue stream. Have the ability to sink my teeth into my might have to go make an acquisition. So we're growing through acquisition. I may have to go make another acquisition to increase my revenue over a period of time, and then of course increase my operating profit over a period of time. When I look at creating new revenue streams, I want to make sure that the first bullet point here says entering new geographic markets. Again, it depends on if it's a physical business that you are actually reporting to every day. If it's FBA, fulfillment by Amazon, or if it's a SaaS solution, a geographic market doesn't necessarily apply unless you're looking at international markets. But for the majority of us, you want to stick to your US markets. Where you really want to pay attention to is bullet point number 3. Okay, you want to align these new services and channels into your existing strategy. So when you look at a, let's take a laundromat for example. A laundromat, hey, maybe when at the laundromat, maybe offer dry cleaning, right? Maybe offer something else that's complementary that is very easily accessible and easily deployable to do. If you're in manufacturing and you're creating a widget, are there adjacent widgets that you can create that isn't that more output financially or from your asset productivity perspective, but maybe you can sell into a different market? So I think that's a really unique thing to pay attention to. In the medical space, what you're seeing is roll-up strategies, right? This is where you've got your influencer saying, well, of course, you could just start buying one company and then go buy 25 others. Outside of that just being a terrible idea, buying companies, it's not a bad one. Buying 25 of them is a problem. But if you buy, say, 2 or 3 or 4 strategically over time, you can drastically improve the value of your current business, but get the economies of scale of having 4 or 5 others. All right, so again, thinking like an investor, taking a step back for a second, when I'm looking at investing my money through whether it's a self-directed Roth or 401k or SEP or HSA or whatever it may be, I want to look at what is the operator thinking about. Is the operator only thinking about the current revenue streams, and how are they positioning themselves to take advantage of new ones? The same thing could be said about operating margin. I skipped a slide, I'll come back. The same thing could be said about operating margin, okay? Are we refocusing on higher margin products or customers, or are we realigning our products and channels accordingly? If we're not paying attention to like the top 5 or 10 or 20% of our customers on a regular basis, we're shooting ourselves in the foot. It's easier to sell to an existing customer than it is to go get a new one. We all know this, right? This is basic ChatGPT Business 101. Yeah, I'm learning everything from ChatGPT now, aren't you? I would also say, when you take a look at SG&A, you're selling general administrative costs, the same things apply here. Always, like every year you should be shopping for new car insurance, right? Whether you're with State Farm or Geico, and if you've been with Geico for 2 or 3 years, switch over to State Farm and have them compete. It's the exact same thing here. Having vendors compete for your business is a good idea, and it helps to maintain a very healthy level of SG&A. Going back real quick, when you're working with your operator, you finally found somebody and you finally believe in them and you finally say, hey, cool, this person looks like they can perform. Take a screenshot of these 5 questions, and then I'll work with Brianna to make sure you get a copy of this presentation as well in PDF form. But a couple of the things you should be paying attention to, right? Like when I do my due diligence, there are hundreds of questions we'll ask depending on which industry we're buying in. But a really big piece of the puzzle for me is number 3. Are there supply chain issues that are delaying me getting paid? Now, you can go to Alibaba, you can go to Temu, you can go to these platforms and find really cheap products, but at what cost? Is the quality good? Is it going to take forever to get here? Are there faster boats available that will cross the Pacific Oceans and the Atlantic Oceans than these large tankers? These are all operational logistical issues that you will have to have your operator answer. So I'm not a big fan of FBA, fulfillment by Amazon, for these reasons. I would much rather prefer a good old-fashioned Midwestern American business that's been around for ages, and they're going to be around for ages, right? They weren't phased by Y2K. Remember Y2K? Yeah, no, but they didn't care about that. They don't care. It doesn't matter what presidents who has the majority in the Senate, et cetera. Yeah, it doesn't matter to them. They know that their business is going to be around for the next 40 to 50 years. So when I'm looking at this revenue growth analysis, I'm thinking, okay, how is my operator going to increase revenue? Not by 200%. That to me is a red flag. How are we increasing revenue? Initially 5 to 10% a year. If we're doing $100,000, if we're doing $1 million in top line revenue, how are we going to make 1.1 million this year? Or how will we make 1.2 million this year? Right? So these are good questions to ask. We talked about COGS and SG&A. A couple of questions here. The largest expense for SG&A is typically labor. And in a world where we need to really give and dive into our people and really give them the right guidance and the right opportunities, so the average tenure inside a company goes from, say, 6 months to a year, year and a half, 2 years, paying really close attention to the type of labor, the efficiency of the labor, and the quality of labor is really important. We need A-plus players on our team. And if we don't have A-plus players on our team, then that generally is a problem. If you've been in the real estate space, imagine if you have a really terrible contractor that shows up 3 hours late and leaves 2 hours early. This person's bad. You're not going to get your flip done on time. You're going to have harder conversations with your borrowers, and that's just a general issue. Labor matters. My recommendation is to always have a revolving job ad on LinkedIn. At the very least, it doesn't cost you a whole lot, but you're attracting talent that may be interested in working inside of this ecosystem for your operator. Okay, so your SG&A, selling general administrative costs, big deal. A lot of people lose the game here. Now, when we're in negotiations with a business, you'll also say, well, this was a one-time expense. Maybe they spent $25,000 building a website. What they'll do is they'll add those dollars back into the earnings, right? So then they'll call that number, adjusted EBITDA or adjusted earnings. So essentially to say, this is a one-time expense, it's never going to happen again, so you wouldn't have to spend this money in the future, therefore the business is worth a little more. The difference between EBITDA, okay, earnings before interest, taxes, depreciation, and amortization, the difference between EBITDA, earnings, and adjusted EBITDA is like fairy tale land. Okay, you kind of have to accept how many adjustments you are comfortable with. Okay, how many adjustments you're comfortable with. If for whatever reason, I've seen this happen all the time, where the CEOs of the companies that are selling will say, well, I'm paying myself $350,000 a year. You could find a CEO at $150,000 a year. So I'm adding back the $150,000 that you're saving. Well, I don't know that, Bob, right? I don't know that. Maybe it could be true that I could find another CEO for half of your salary, but what if I don't? I can't add back that $150,000 onto the P&L and pay you more because that's what you think. So when you're entering this space, just keep in mind, it's not a regulated space, okay? Like business brokers, the only license really that you need to be a business broker is a real estate license. Think about that. The only license that you really need to be a business broker is a real estate license. So what does that tell you? This industry is not regulated, right? So you will, and by the way, when you're communicating with business brokers, they generally also do not have like any kind of financial modeling or accounting experience. So talking to them about Google Sheets is like speaking Greek to them. What you want to make sure that you're doing is connect with an operator that's done this a bunch of times, but then also have a really good finance team in place to really help you. Let's talk about asset productivity and asset utilization. I'll pause after this for questions. Your AP/AR management, one of the key, easiest lifts that you can do is if you're paying too early or too soon, which is what we do in all of the businesses that we own, is let's say we're paying too soon and we acquire a business and we notice, hey, your accounts payable is 5 business days. We'll extend that out to 30 business days or 30 calendar days. What that does is it gives us a little more breathing room and more cash flow to do what we have to do with the business. Now, our goal is not to screw it up. right? Not to mess up that AP/AR cycle. And when you are in a position of a new acquisition, the first 72 hours, the first week, you want to start reducing that accounts receivable. Working with the government, for example, you may have government contracts. Those government contracts, the nets are like ridiculous. Sometimes they'll be 30 days, sometimes they'll be 120 days. So to offset the longer AR cycles with the government, if you have government contracts, look at private contracts and then have all your private contracts pay within 15 to 30 days. And if you need to take a 5 or 6% haircut for somebody to pay within 5 to 10 days, do it. Asset utilization, we talked about the example here of a really big, say, machinery. If you have machinery that's being used on a regular basis, pay attention to maintenance, but also pay attention to the industry standard for that piece of machinery. Should it be out there 90% of the time? Should it be out there only 30% of the time? So zooming out with all of this, if you're looking at investing in a business, these are all questions you should be asking your operators and asking the business owner. More often than not, what I'm finding in this space is you've got a lot of people that are not doing the due diligence on the businesses or on the industries themselves. The operator may be just fine, but the due diligence is what's lacking. And what you end up running into is, hey, it's going to be all handy dandy and amazing the first 6 months, and then the business tapers off. Now, you've got a couple of options. You can work with the individual, or you can say, I'm out. That generally doesn't go well because now you're going to strain the business and the cash flow will suffer. But generally speaking, if we as investors do our due diligence up front, especially on the industry and especially on the business, then we should be generally okay. All right. One of the reports that I like to read is from Ibis World. I, B as in boy, I, S as in Sam, world.com. That gives you a bearish view, okay, a bearish view. So essentially you're reading reports telling you that everything is crap and we're going to get hit by an asteroid in 2030. But I'd rather know the downside risk of the businesses and be able to solve for that way before I invest or acquire one. So I've got a newsletter, it's called the Investment League. It's completely free where I talk about these types of opportunities and I just offer really interesting diligence thoughts and ideas. So check out theinvestmentleague.com if you've got any questions. But what I'll do is I'll stop here for questions. And I know we're doing pretty good on time. I probably have another 15 minutes or so. But if you, hold on, Brianna, do we do questions just straight at the end? Do you want me to do that?
Yeah, so we can add on this question right now if you feel comfortable answering that first. It's from someone online asks, if you aren't utilizing brokers, how are you finding businesses for sale?
If you're not utilizing brokers, how are you finding businesses for sale? Good question. So a couple of ways. You can use LinkedIn, SalesNav, put them through an email funnel, then a landing page, and offer them some kind of PDF or private audio podcast that gives them a reason to sell to you. Generally speaking, though, working with a business broker is okay. Why? Because they will have more information on the business, and generally they'll have some set of financials for you to look at. If you're approaching a business owner kind of cold, it's going to suck. It's going to suck because of the total number of conversations you'll have to have. Then it's like pulling teeth to do their returns. Like we've got tax returns coming up in like a couple of weeks, right? Corporate returns are due March 15th and then personals are due April 15th. You think business owners in America today are filing everything on time? Do you file taxes on time, right? Like, to be honest. And so for us to properly evaluate a business, I need tax returns, like transcripts, I need P&Ls, and I need bank statements, and all of that has to line up, right? And more often than not, what you'll find is if you have a business owner that hasn't done these things and you're working directly with a business owner, it's very easy to go to Fiverr and falsify all this stuff. But you can go to Fiverr and say, hey, create last 12 months of Bank of America bank statements. Yeah, it sounds like a terrible idea. So that's why working with a business broker who has a real estate license, generally at least you'll get some level of competence. But it doesn't mean that they either have done deals in the past or they know how to broker a business. They just happen to have a real estate license. But it also, in the minds of a business owner that wants to sell, it creates a level of trust knowing that they're working with somebody that has some license in some manner. So my recommendation is working with brokers. Now, if you don't have the P&L or the balance sheet to prove to a broker that you're worthy of their time, then that's a separate issue altogether. But I do recommend working with brokers. The other way that I do it is Google Ads. Google Ads, Meta Ads, and create an offer for business owners that they cannot resist, that they will punch in their email and give you something for free. So this entire presentation is from a course that I created. It's about 14 and a half hours long, called The Order of Operations. All right, The Order of Operations is a course, I'm not selling it, it's a course that I give away for free. It's got slide decks, calculators, it talks about the key metrics you need to pay attention to if you're a startup owner. So there are four stages of any business: startup, growth, maturity, and decline. And most people generally don't know what stage of business they're in. Okay, like you might think you're in growth, but you're actually in decline. And then the ideas that you might have for growth is let's go spend more money on marketing, and we'll see an increase in revenue, which in fact is probably the worst thing you can do, which is taking a plane, pointing the nose down, and hitting the accelerator, like hitting the gas. Now you're going faster downhill than you want to, and frankly, you don't even know you're going downhill. So all of this to say, I would take a look at these business owners, market to them on Google, market to them on Facebook, come up with an offer, and whether it's a course like what I've done, or it's an ebook or some kind of private podcast or interview series, give them some value. Don't just sell them on, hey, I can buy a business. Everybody's doing that because that just happens to be the new flavor of the decade. You remember when everybody was like a flipping guru, and then now they're all multifamily gurus saying, hey, I own $1 billion of $2 billion or $3 billion of multifamily apartment complexes, but then you realize they haven't operated any, and they have a fractional minority LP position in them, and they have no decision-making capability. Yeah, that's what's exactly happening in the business brokering and business ownership space. People telling you to go buy laundromats. It's a great idea. All right.
Great. Thank you for answering that. One more question from the same user. Real estate, do you avoid certain states to purchase businesses due to local regulation? Which I think is a fairly common question on this topic.
Due to local regulation, regulation regarding what exactly? Like, are we talking about short-term Airbnb, HOA issues?
That's been the most common recently that people talked about because it's been so prevalent recently. So I would say yes, but
Okay.
to the user who made the comment, please feel free to clarify.
Yeah, a clarification would be good. I would say I used to do Airbnb, and then I luckily got out before COVID hit. So I'm not doing any form of short-term rental. To me, it's a headache. Frankly, to me, investing in single family is just a headache altogether. It's not enough money. Your short-term gains and it alls. I mean, there's so much work for such little money. It's insane. If there is something that I would pay attention to in the real estate space, specifically single family, it would be midterm rentals, geared toward travel nurses. So travel nurses are they're needed in this country. They're frontline workers, and they are sleeping in their cars in between Airbnb stays because they cannot find Airbnbs to book long enough. Think about that. That's a problem. Healthcare in this country is a problem. There's a healthcare shortage. There's a shortage of healthcare professionals, doctors, NPs, MD, etc. And we're not serving them at all. This is a really big opportunity. And generally speaking, HOAs, they only have rules for short-term rentals. What's a short-term rental defined as? Just make it a couple weeks longer. So midterm rental is where I would pay attention to. But my first inclination, as I mentioned in the wealth creation model, to the user is buy a business first. That business makes you cash flow. Take that cash flow and invest in real estate. And I'm state agnostic. I don't care, right? We'll go to Indy. We'll go to Michigan. I'm from Michigan. So Michigan's great. We were acquiring in Battle Creek. I love Grand Rapids, by the way, GVSU, Grand Valley State University. They're really nice. They're doing a lot of things with the medical mile there as well. So we got in before all that happened, which is great. And I do a lot of speaking around the country too, which helps me to always stay clued into different areas. Yesterday, I had a conversation with a gal out of Sierra Vista, Arizona, and Sierra Vista has, I think it's like I don't want to misquote her, but it's like the world's only like some kind of military training base, but it's like a specific type of base. And rental rates in Sierra Vista, Arizona are like, I mean, for a 4-bed, 3-bath, it's like $2,400, and there's not a lot of inventory. I would take a look at markets like these. That's what I would do. I would also, from a single-family rental perspective, I would also work with cities and municipalities and address home affordability. I'm working with someone now who has a really good beat on a couple of cities in Georgia, and we're acquiring properties for $15,000 to $20,000 by working with the city because we're getting all these credits, and then we'll rehab them for like 90 to 100, and then we've just got people that want to buy them, teachers, medical professionals just starting their careers, and they'll buy them at $175,000 to $225,000. So that's something that I'm working on right now with this person. But these are opportunities that are very viable. You just have to go sniff them out. And if you're doing what every other retail self-directed investor is doing, you'll make money. But I think it's one thing to create generational wealth, right? It's another thing to not. So I hope that answered your question. If you have any additional clarifications, please let me know. Literally, I've got 3 minutes on this. I'm just gonna I'm gonna zip through this and we'll open it up for questions for 15 minutes. But here's the thought process behind multiplying your return on investment. Okay, so let's say you've got $100,000 out or $50,000 out or $200,000 out, whatever it is. There are a couple of key questions that you should ask. And in fact, there are 10 key questions you should ask. The first, what type of team is running this thing? Right, so everybody knows there's no I in team. Nobody can do. There's no one person that can do everything. What's the team? The team matters. Next, when you're looking at acquiring a business, whether it doesn't matter what you're acquiring. If you're acquiring a business or a piece of real estate, what is the acquisition target? What is the value that you want to create here, and where do you think the valuation for that business can go? Specifically related to the business, are you buying in? Are you going to go buy a software as a solution business? Are you going to go buy a salmon farm? I think I've referenced salmon farming like 3 times only because you'll be surprised how many like tons of salmon Americans eat every year. It's kind of crazy. Not tilapia though. If you're a tilapia person, tilapia is like the fish they bring in to like clean up after the salmon. So all that tilapia at Costco is pretty gross. Step number 3. Sorry. This is what I do on Saturday afternoons. I just look at the camera and make myself laugh for no reason. Acquisition targets. We took a look at revenue and expenses. We talked about driving revenue and then paying attention to your growth, essentially your EBITDA margin, your expenses. So these are the 2 things you want to pay attention to: revenue and expenses. What's their USP? Are they doing anything unique, or are they just kind of doing the run-of-the-mill thing that they've been doing for the last 40 years? And who are you paying? What are my APAR cycles? Does this make sense? Should we be having these Should we be having these expenses? Step 3, how can you lose? How can you lose your money? Answer this question. How can you lose your money? We can lose the money if the market goes belly up. Okay, got it. If the market goes belly up, what's our contingency? All right, step number 3. I'm probably only going to get through like 5 of these steps and then we'll stop. Once we understand how we can lose our money, then the question is, we need a mitigation strategy for each potential risk. So I have an electrical engineering degree from Michigan. I haven't used it at all, but one thing that I do use it for is mitigating risk. In a complete worst case scenario, how do I maneuver? Because it's going to happen, right? There's no one operator that says, I've always made money. No, I've made money, I've lost money, I've had to buy people out, I've had really annoying investors. I've had to buy them out. I've had to deal with really annoying employees. I had to buy them out, or I had to lay them off, or we had to fire them, or we had to strategically move them somewhere else inside the organization. Stuff happens, right? This is like real life stuff happening. And being able to take those in stride doesn't bother you as much, especially if you have a mitigation strategy for each potential risk. Okay? We'll stop at number 5. If you've got additional questions for steps 6 through 10, certainly let me know. But step number 5 is by far, I would say, one of the more important ones. Who's the number 2? Does the business you're investing in have a go-to strategy in the event the main person is no longer available or dies, right? And in the world that we live in today, baby boomers are getting older. And if you're working with somebody that's 75, 80, 85, 90 years old, the question is, okay, well, how much more time do they have on this planet? And do I have 5 to 7 years with them, or do I have 2 to 3 years with them and have them train the number 2, right? That's such an amazing experience that they can translate and give to somebody and give to a number 2. The question is then, is that number 2 worthy to step into that place? And do you have a backup for number 2? So I'll stop here. I know we've got questions now for the next couple of minutes. Email me for the slides, or I'll send them over to Brianna. She'll do a wonderful job in getting them over to y'all. But there we go.
Even better, Abby, while we wait for questions to roll in, if you have the time, we can go through the rest of the slide deck, and then I'll pop up back on when I see a question come up for you.
Yeah, that sounds great. Step number 6 then, I want to take a look at the growth strategy for the target business. Right? When I'm looking at a business and then when I'm looking at how do I, once I've acquired it and I'm putting myself in the future, now that I've acquired it, what are we doing to grow it? We're currently exploring a dental opportunity in the Northeast. This dentist, a selling dentist, has 5 locations. The selling dentist wants to grow to 8 locations. Cool. That clues me in. How do I make that happen? Right? How can we get there sooner? What are the licenses that we've got to put in place? What are the credentialing? What is the how heavy is a lift for the credentialing paperwork with the insurance companies? Right? These types of things matter. So, what's the growth strategy? And is it general dentistry? Are we going to focus more on Invisalign? Are we going to do? Are we going to bring in ortho? What's the goal? That's step 6. Step 7. Culture matters. Everybody knows culture eats everything for breakfast. If you don't have the right culture, you don't have the right team, you don't have the right attitude, you lose. It's that simple. Efficiency, the more efficient, the reason that employees are efficient is because they have a great attitude when they come to work. That's why I love Chick-fil-A. I love Chick-fil-A. Outside of the fact that I have a personal issue with them recalling the Polynesian sauce, I come on, man, right? I can't. Like, this is just frustrating to me. I'm a Polynesian sauce guy. I don't know how many of y'all are, but if you haven't had the Polynesian sauce, it's so good, and it's going to suck for you because you won't be able to have it, at least for the foreseeable future. But one thing that I absolutely love stepping into a Chick-fil-A is their attitude towards serving you. They're always smiling, they always are friendly, and they have no problem answering questions about the food combinations or sauce combinations that they recommend on different sandwiches. That kind of culture is infectious. And it's infectious for not only the employees and the managers to build a better company and team, but it's also infectious for your customers and clients. So culture really matters. When you are buying a company, and let's say you've got a target acquisition in mind and you already have a business and you want to integrate the two, what is that strategy? It's not easy just to say, hey, we're going to go buy a company and hey, all of a sudden it's all part of the portfolio. If we're bringing it in-house, there's a very specific integration playbook that we use to bring in HR, payroll, AP, AR cycles. Like this, everything has to then fall under one wheel. Right? Imagine if you've got 2 different wheels turning at 2 different rates. This is a problem, right? There's no way you can build a Formula One car with Toyota parts. So very similarly, we take a look at integration very, very carefully, and the people behind the scenes are rallied, and we create a North Star and a deadline for when we want to have these 2 companies integrated. This is a larger topic. I feel like I was a bit vague here, but this is a very important topic. Happy to discuss it offline if you would like, but if you are buying two businesses, or you have one and you're kind of merging another together, or into your folding it into your existing ecosystem, then that could be complicated. People's toes get stepped on. They lose confidence. I've seen this happen where people lose confidence in the actual leadership team, and then they don't know who their boss is. Maybe they have two or three different bosses now, and it becomes the TPS reports in Office Space all over again, right? So that's something to just avoid. That then turns into a company culture problem, and if you have a company culture problem, then it's more likely than not you probably have a financial problem, and if you have that, then your customers aren't being serviced, and now you have a reputational issue. So all of these things are like this big cog in a wheel. Again, zooming out for a second, if you are considering investing in businesses using your self-directed accounts, highly recommend getting some of the questions answered that we're talking about today. Right? This is if you want to go down that rabbit hole and really accelerate your strategy. Step 9. What do you want to do about your employees? Like, what do they care about? Well, they care about job stability. They care about going home to their families, going home to their partners, and saying, hey, honey, everything's going to be okay. The leadership team here during this acquisition, they're phenomenal, and they're here to stay. How amazing of a feeling is that, right? And I'm sure many of us have experienced that in the past too. So you really want to get into what the employees care about. And maybe there's an employee that has this fascination with accounting that you might be able to promote to a fractional CFO. We did that very recently with one of our portfolio companies, and she's never been happier. Like, she's just ecstatic, where the previous owner never gave her the light of day or never gave her the chance in the 41 years that he had been operating this company. Ask your employees what they want to do. It's a really good way to get to know them. And another pro tip, just because you buy an operating company or you're investing in one doesn't mean that you should be making changes right away. Wait 6 to 8 months and then slowly start to institute changes. You need to earn the respect of the employees before making major changes. You need their buy-in, and then they'll give you the go-ahead and the confidence to say, hey, we believe in you, let's rock and roll. Last but not least, if you want to increase the valuation of your company, what you want to pay attention to is whether or not you are tech-enabled. Technology helps to streamline a company. And a streamlined company in the future looks really good to potential acquirers. And that multiple, when we take a look at the exit multiplier of a business, that can then increase, say, from 3 to 4 times to 5 to 6 times. We can have an entire conversation about valuation. Maybe that's another conversation for a different day. But using technology, and we all know whether it's AI or AI enabled or CRM systems at the very least, using something like this to help the employees get to get them to a place of happiness better would be helpful. So that is step number 10. I'm getting yelled at. So here's the info, theinvestmentleague.com. It's a free little newsletter. It's just something that I offer for my overall insights, and that's what I got for you. So Brianna, thanks so much. I really appreciate it. Sorry for the interruption.
No worries at all. And of course, thank you so much for taking the time to join us. I have one question for you from one of our viewers today before we close out. Do you use SBA loans and or private equity to purchase businesses?
Both. SBA loans, remember, you've got a cap at $5 million per loan. They came out with different rules, so happy to kind of go through those rules offline if you would like. Private equity too, it depends. It depends. Private equity can be a little more expensive, right? You're looking at your 8 to 12 potential pref and a return on equity plus ownership of the business. So that is something that we generally may offer, but it's something that, outright, it's easier just to go, at this point for us, it's easier to go conventional or SBA because the money is cheaper. So that's a good question.
Great. Thank you so much, Abhi. I am going to pull up this one screen before we let you go today. For anyone who's enjoyed some of the content that Abhi's brought to the table today on a more unique and advanced topic in the investing world, you can catch him at the Quest Expo coming up on June 27th through 29th in Irving. So if you are interested in alternative investing, IRA investing, or networking and getting in contact with IRA investors, this will be the place to be. Certainly scan the QR code, check out the link, and we'll let you know what the schedule looks like as of now. Thanks so much, Abby. Have a great rest of your Saturday.
You too. Thank
Thanks.
you. See ya.
All right, everyone. We are going to close out very quickly just with a few announcements. Of course, as you may know, if you frequent Quest events, we do have socials that take place in our Houston, Austin, and Dallas offices. So this is the next one that we have coming up here in May. So you'll see the respective dates listed. You can register through the QR code. We are going in this series of socials going to be celebrating Military Appreciation Month. So we're going to hear from some veterans turned investors about their journey, how they got to where they are now, and some of the ways they found success in the alternative market. So, really exciting topic. A couple of these will be streamed live for those of you not in the Texas area, but we'll have more information about that on the registration page. So, I highly encourage you to check that out. With that said, we also have a special edition of our self-directed Saturday. Typically, the classes are an hour long, and we hear from one speaker who kind of talks through what their specialty value that they can bring to the table is. But this one's going to be more focused on a wide array of millennial investors who are sharing their strategies in different portions of the market and how they were able to find success there. So this is going to be a really great event. Of course, all online, all free for you to view. It's going to have some really wonderful speakers who are going to talk about what exactly it was that got them to where they're at today and what they would recommend to those of you out there who are budding investors or who are starting your business and are looking for a little bit more information on the ins and outs of how that looks for those who have had success in the industry. So again, link will be in the chat. You can scan the QR code either way. We would love for you to join us on March 23rd, same time, but just a little bit longer. It will go until 3 p.m. Eastern. I want to wrap up with a promotion that we are running. If you're interested in investing into alternative investments with your self-directed IRA, really special promotion we're doing in honor of rodeo season. This is going to last until March 31st. So if you are looking to open an account, if you fund it by the tax filing deadline of April 15th, we will credit your account $125. This means your first investment purchase fee is going to be on Quest. So for those of you who are motivated to get started and have already identified the deal, I highly encourage you to sign up. I'm going to actually leave our QR code to schedule a consultation on the screen while we close out. Scan this code, email IRA specialist. We will be very happy to talk you through the many possibilities within the plan, what that might look like for you. Or on the flip side of things, if again you're looking for IRA investors, we have events in different ways that we'll be able to connect you through those mediums. So I want to thank everyone for taking the time out of their afternoon today to listen to some very valuable information in the space. And we do hope that we can see you the same time, same place next weekend. Thanks, everyone. Enjoy your Saturday.